Good morning. Today is Thursday, March 24th, and thank you for joining us today. We're just getting in some economic data, and it's pretty interesting economic data that we are getting in. We did get durable good orders for the month of February that disappointed somewhat, but on the positive side, initial jobless claims coming in extremely well. Just 187,000 new people filing for jobless benefits last month, which is about as low as I can remember even before the pandemic. And that's down from 214,000 last week. So really good numbers there. And that can't be good for bonds, Tom, as bonds continue to sell off even before this data came out this morning.
Yeah, it's been a very red day already to start. We had a little bit of relief and a little bit of tick up yesterday, but we're continuing the march downward on bonds. Still got some unusual bumps in the curve in terms of the 5 and 10s being inverted, the 20s and 30s continue to be inverted. And we're all the way up to about a 215 on the 2-year treasury. So not a lot of places to hide right now. But we should have some opportunities for buys as bonds roll off here on 4/1, which is a big maturity day for bonds. We should have a lot of money coming due that we can get redeployed into some of these new higher rates. The question is, are they going to be even higher going forward after that?
Yeah, I think the big question mark that a lot of people are trying to wrestle with right now is how are these higher interest rates going to impact housing, and how and what does this economic data actually look like in terms of currencies and central bank policy as we move forward with that. And we'll actually touch on those topics toward the end of this call. But first, we want to start off with Russia, Ukraine. It's the shark closest to the boat right now. And the big news out of Russia and Ukraine, of course, we have the NATO summit and we have the G7 meeting coming up later today. But the big news is what's going on with markets there. And I think what a lot of people might be surprised at is that the Russian stock index has been closed for the last month, since February 25th. Since that time, obviously, Russia's invaded Ukraine, and a lot has happened on the world economy. We've unloaded tons and tons of sanctions. And for the first day since February 25th, Russian stocks actually opened up. And I think if anyone was really betting on what stocks would do, I don't think they would say that stocks would go up. And certainly, I don't think they would say that stocks would go up 7%. Russian stocks are up 7% today. They were up as much as 12% earlier in the day. You had companies like Gazprom, which is up 15%, getting free assets from their former Western partners probably helps with that. But I think what we're seeing is that these sanctions have really taken a lot of the headlines, but in terms of actual economic impact, again, we'll talk a little bit about this further on in the call, but it's not really had that much of an impact. And it's even in ground zero, where the sanctions are supposed to hit hardest, you now have the market that's up over the last month, and not up by a little, but up 7% over the last month. There are some caveats with that. Only 33 of the 50 stocks actually were opened. It was only a 4-hour market session versus the normal market session. It's the 7%. I'm measuring that in Russian rubles. If you look at it in US dollar terms, it's actually down 8%. But what's interesting is that the 7% did outperform the US market, which is up 1.7% over that time frame. Other caveats, short selling is banned in Russia, and foreigners are banned from selling. Now, foreigners may have Russian assets, but usually it's not on the local exchange. So I don't think that that's playing as much a role as people might argue. And you did have the sovereign wealth fund that said that they would support the Russian stock market to an extent. But again, I don't think that that's driving the stocks up 7% today. I think this is a relief rally. And I think that the Russians have actually managed this fairly well. Tom, any thoughts on the market reaction, or just how markets tend to respond to situations such as these?
Yeah, I think anytime that you take trading completely away, uncertainty mounts to a degree where it's almost impossible to make a call on that. And I think that The sanctions, to your point earlier, I think are not as effective as we think they are. I was reading an article last night that's saying that a lot of the sanctions actually are having some unintended consequences. Are actually hurting the U.S. a lot more. Specifically, the Russia deciding that they're no longer going to receive payments for their oil in U.S. dollars. They're only going to take rubles, which chips away at the reserve currency status of the U.S. dollar. They continue to stay that way, even post sanctions, that just takes one more, support out from underneath us as the reserve currency. And if the dollar loses its reserve currency status around the world, that can be a big problem for us in terms of our credit quality as a nation. So, it's interesting when you think about, man, this is going to really crush Russia, but then their stock market opens up and, really the only thing that's happened is the dollar's been undermined. It's not a great look, and it's a little disappointing.
Yeah, I think it's important to keep this in context. It's been a month, but at the same time, it does seem that some of these economic sanctions that we've been bragging about for the last month seems to be a little bit diminished in terms of the ultimate impact. I don't know what else we would do, because I don't think that anyone's really advocating for a hot war in Ukraine with Western forces, but you are seeing the limit of what the sanctions can do. And clearly it's not deterring Putin from continuing his war. Nevertheless, I think you are distracting the Russian people and you're hurting the Russian. Again, only 33 of the 50 companies actually open for trading today. So we're dealing with a very small sample size here, but it's something to bear in mind going forward. In other Russia news, you do have the NATO meeting and the G7 meeting taking place today. Europe is looking at the impact of what it would look like if they didn't take Russian gas over the winter. Obviously, 40% of Europeans' gas needs comes from Russia today. So obviously, they would be kind of cold next winter if they don't find a solution to some of these gas issues, if they do indeed put sanctions on Russian energy. The Germans continue to say, look, we're not even looking at energy sanctions right now because of the dramatic reduction in the size of the economy that would result in Germany because of putting sanctions on Russian energy. At the same time, European leaders are looking to the US, and we're looking to sign a deal aimed at reducing the European dependence on Russian energy. An agreement could be announced as soon as Friday, as soon as tomorrow. And basically what it's doing is looking at ways to increase LNG supplies over the next few months and years to Europe. Jamie Dimon, the JP Morgan CEO, has recommended a Marshall Plan to increase US natural gas production and reduce development time for wind farms. The problem with all this is that it's great to secure American energy independence, but natural gas is a lot more difficult to transport than oil because it's a gas, and anyone who's taken chemistry knows that gas takes up more space than liquid. And that's the issue with natural gas. And so in order to transport it, you have to significantly cool the gas and turn it back into a liquid. You got to take it down to, I think it's down to about negative 150 degrees in order to liquefy that natural gas. And then you have to keep it cold to transport it. And then you have to regasify it in a proper way, because you can't just allow it to expand on its own and basically cause very quick and rapid expansion of that gas, which would be extremely dangerous. So you have to liquefy that first, and you need a liquefaction terminal. And the problem is, in the US, we only have a few liquefaction terminals, and they're all at capacity. And they all have contracts with, a lot of them with Japan. And so those contracts are going to have to be redone. And I think that's going to be in the process of happening. And then you're going to move that over to Europe. And the regasification terminals, those are a little bit quicker. You can build those a little bit quicker. But the problem is, on the LNG side, on the liquefaction side, I followed this in 2011 to 2016 extremely closely. I was working in Oregon at the time, and there was a huge potential project, LNG project, that was looking to be built in Oregon. And I had a vested interest in this because I lived over there and I really wanted it to be built. Now, the problem with building an LNG terminal is that you need approvals from the Department of Energy and you need approvals from the EPA, as well as the state and local approvals. And those approvals were vicious to get. It took years and years and years to get those LNG approvals. And so there's only been a few terminals built. And if you look at the timeline of how quickly we could build new terminals, it's going to take a very long time. Bottom line is, we can talk about exporting LNG to Europe, but it's not going to solve their energy needs, no matter how much natural gas we produce, because you have to liquefy it and then you have to regasify it. So Europe is in a very dodgy situation here. I think ultimately what they would need is they need more gas from Saudi Arabia. They need more pipelines. But again, a lot of those roads run through Russia. So for the Europeans to sanction Russian energy, especially Russian gas, that would be a huge step for them and something that would really be negative for their economy, in my opinion. Separately, finally, on the Russia side, U.S. is set to announce additional measures against Russian political figures and oligarchs today. Apparently, Ukraine, Zelensky has asked Biden not to sanction Roman Abramovich. For what reason, I do not know, but that is also a story today. Moving on to some of the economic data, I think, again, we've seen the market volatility. We've seen the market volatility in Russia, in Europe, and the U.S. In terms of economic reduction, I think it's interesting seeing some of the first economic data for March that's coming out of Europe. And we're getting this out of the Standard & Poor's. Their global Eurozone composite index, anything above 50 is expansion. Their composite index fell to 54.5 from 55.5 in February. So it only fell 1 point, and it was better than the 53.8 estimate. So this is to say that Europe is still actually expanding. And the reason it's expanding is because you've seen the fall off in the Omicron COVID wave. You've seen a little bit of reduction in activity on the manufacturing side, but if you add those together, you're still seeing overall expansion in the economy. The UK actually is expanding dramatically quickly. Their composite number went up to 59, was 59.7. That was only down from 59.9 in the prior month. On the services side, they're at 61.0, and that was actually up from 60.5 in the previous month. So we're actually seeing economic activity improve in some of these areas. Some of the manufacturing issues are there, but on the services side, European economy is opening up, and I think this is good news. Tom, anything to add on some of the economic data?
Yeah, I think it was a bit of a surprise for everyone. I think if you juxtapose the fact that we're having the Ukraine situation heat up and potential ECB hawkishness with the fact that we're also simultaneously seeing the UK and France and a lot of these countries start to drop their COVID restrictions altogether, I think that might be the offsetting factor, which is that on one hand, you're seeing a war situation where things are slowing down on the manufacturing side, but on the flip side, everyone is leaving their homes for the first time in a long time, particularly places like France where they've been exceptionally locked down and had all kinds of restrictions. So there's a little bit of an offsetting point there, which I don't think people were anticipating as much, but that would be my guess as to why we're seeing the strength there, is you're sort of seeing that pendulum swing in both directions, but kind of in two different separate parts of the economy.
Thanks, Tom. One thing that we've been doing here at the office, a lot of us recently bought homes in 2019 or 2020, is we were saying how much more would we be paying for the home today than we did back then. And so what we do is we go on Zillow, look at this estimate, subtract the down payment that we made, and calculate the mortgage payment at today's mortgage rate, which is about 4.6%. And it is pretty significant how much more we would all be paying for our mortgage today. Having said that, we did get news out of KB Home. And I guess Tom, myself, Andrew, Sam, who works here, must be in the minority because other people are not having issues affording homes. Demand continues to be extremely strong. KB Home's backlog is up 55% on a year-over-year basis. Their guidance for average selling prices, they just rose this quarter. It's now 490 to 500,000, up from a prior estimate of 480 to 490,000. The return on equity guidance that they have, which again, anything above 20 for me, for a home builder, is quite good. They had previously said that their return on equity this year would be greater than 26%. Now they say it's going to be greater than 27%. So home builders are doing quite well, and that's driven by demand. They still have shortages. They mentioned flexible ductwork was an issue, appliances. They said last year they had this new regulation for double ovens, this new federal regulation for double ovens. A lot of appliance manufacturers had to go back and retool their factories. That caused massive disruptions in the supply chain. And so KB Home has actually been buying double ovens from retailers because we have such a shortage of those. That's getting a little bit better in the last few weeks, but it's really hit their quarter pretty significantly. They also have constraints on, they mentioned garage doors, windows, cabinets, HVAC systems, signing, and they're really trying to figure out ways to mitigate these issues. But with all those shortages, demand still remains very strong. They said the biggest challenge today is completing homes, not selling them. Demand continues to be robust. They say driven by favorable demographics. You got employment growth, wage growth, and the shift to working from home is another factor supporting demand. They say pricing power is actually quite strong, and affordability, quote, remains reasonable. They say 2/3 of buyers have qualified for a conventional mortgage. Loan to value ratios are stable at 85%, which implies an average down payment of more than $70,000 as a down payment. And then FICO scores continue to average all-time highs of about 732. So the question was asked, what are you seeing about mortgage rates? Is that denting demand? And they say that so far rates have moved, but we're not seeing any evidence of a shift. So when you put that in context of no houses available and strong demographics, they say that we're not seeing any change in behavior. Don't have a crystal ball on what will happen if rates keep rising, but so far we're not seeing signs of anything slowing down. And so I take that as positive news for the economy. I take that positive news for homes. And I think it's quite interesting, and it demonstrates the amount of cash that maybe not the average person in the US has right now, but certainly the upper 25% or so, which is what you need if we're talking about new home purchases, because there are 330 million people in the US, and we're only building about 15 million homes a year. So you don't need to sell 330 million homes a year. Tom, thoughts on affordability, thoughts of when will this hit a breaking point, and thoughts on maybe KB Home's commentary?
Yeah, I just worry that if interest rates continue to rise, that it's just going to be almost like 2007 again, where you have so many people rushing to get into a house that they're going to end up getting over levered. And sure, your credit score might be 800 going into buying your home, but you get to a point where you hit a crossroads where you can't pay it, and that 800 becomes a 500 really quick, and you're out of a house and out on the street. So I just wonder how aggressively this can accelerate, because either prices go up or interest rates go up. But if they both go up, that's an exponential effect on the affordability of houses. I mean, you and I just running through that exercise of what would it be like to buy our current house now. I mean, I would be paying 45-50% more to have the same house if I just bought it at this price that it would theoretically be at on Zillow right now at current interest rates. So some of that is the price, some of that is the interest rate, but the combination of the two makes that affordability a lot less very quickly.
Yeah, I very much agree, Tom. And I think that we're going to have to continue to focus on this and look at these earnings calls and look at these mortgage applications and make sure we're monitoring those carefully to look for signs of weakness. Because right now we're not seeing that. But this is why we continue to follow it, is because we do want to find that when we start to see those signs of weakness, because that could be a foreshadowing of some things to come. But right now, big shortage of homes in the US, tons of demand, and the demand is really outstripping supply, resulting in significant price increases. So with that, we'll let you go. We will see you here tomorrow morning, Friday at 8:30.